young boy Jack read his first book without pictures when he was 7 and immediately determined to become an author when he grows up. When time came to apply to colleges, he studied English literature, then he married and eventually decided to pursue his long-term dream of writing a novel. In this video, I'll be using Jack and Jane and their life events for 2022 to show the differences between a tax deduction and a tax credit. There are a lot of similarities between tax deductions and tax credits in that both of them can reduce your tax liability, and both of them are available to you as an individual and as a business. However, there are very stark differences between the two. Tax deductions reduce the amount of income that is subject to taxation. So deductions are beneficial, but they don't reduce your tax liability dollar for dollar. The credits, on the other hand, they don't reduce your income, but they do reduce your tax liability dollar for dollar. And some credits are refundable, meaning that if your tax liability is $0 already, you can receive a refund from the government because the particular credit that you are claiming is refundable. Please note, not all credits are refundable though, so some credits can only reduce your liability to $0, but would not generate an additional refund for you. So in our rudimentary example, we have Jack and Jane. They're both working and they receive W-2s. Let's say their salary for 2022 was $40,000. But as I mentioned, Jack wanted to publish his first novel, which he did, and let's assume without any complications that the net income from his novel, meaning all the revenue minus the expenses that he probably incurred in publishing his novel, added up to $50,000 per year. So their total income for 2022 is $90,000. So let's see what deductions are available to Jack and Jane in 2022. First and foremost, there are things called adjustments to income, which are practically and effectively deductions that reduce your taxable income. And because Jack has self-employed earnings by issuing and publishing his novel, he has to file Schedule C reporting his self-employed earnings, and this triggers a self-employment tax. Self-employment tax is basically Social Security and Medicare, and if you have self-employment earnings, you're responsible for the entire amount. Normally, if you're a W-2 employee, you only pay half of Social Security and half of Medicare because the other half is the responsibility of your employer. But if you have your earnings that don't come from your employer, you're responsible for the entire amount on that earnings. And because it does sound very unfair, the IRS allows you to take an adjustment, which means you can take 50% of your self-employment tax and reduce your income by that amount. So the way that self-employment tax works is that 92.35% of self-employed earnings are subject to the self-employment tax, which is the entirety of the Social Security tax and the entirety of the Medicare tax. In our case, Jack has made net $50,000 from his business venture, which gives us $46,175. If we multiply that by 15.3%, which is the total self-employment tax, we derive $7,064. This $7,064 is actually extra tax that Jack will have to pay on his tax return because he has income that is not associated with an employee. However, the adjustment to income is the half or 50% of that liability, which you will see here reported on Schedule 1, Part 2, the deductible part of self-employment tax of $3,533, which is exactly 50% of $7,064, which is the extra self-employment tax. So this adjustment to income is effectively the deduction. However, there are other deductions that the family can take. The standard deduction that is available absolutely to everyone, but it does vary depending on your filing status, and it does vary depending on the tax year that you're filing, because this number is adjusted for inflation every single year. For 2022, because they're filing married jointly, the deduction that they receive is $25,900. But aside from those deductions, there is one other deduction that came into place with the 2017 TCJA Act, and that deduction is called Qualified Business Income Deduction, or QBI for short. So So this QBI deduction is normally, as a general rule, not available to specified service trade or businesses, or SSTB for short. So SSTB is a business that relies on their skill or reputation. For example, if you're in the industry of law, health, accounting, actuarial sciences, if you're an athlete or a performing artist, this deduction should not be available to you unless you apply under one of those exceptions. The exceptions spin around the amount of income that you derive from that SSTB. If you derive less than the threshold, then the SSTB would be eligible to apply the QBI deduction. And in our case, the limitation, the threshold for merit filings jointly is $315,000. And in our case, the taxable income for Jack and Jane is way below that threshold. So they would be eligible to claim that deduction. So let's see how to calculate it. So to explain all the aspects and intricacies of calculating the QBI deduction will take an enormous amount of time and will make the video very boring, a lot more boring than it already is. So I will only talk briefly about the overarching rule of the QBI deduction, which is a deduction that is equal to 20% of your qualified business income. However, there are certain limitations. If you have certain dividends or income from publicly traded partnerships, or if you have capital gains, there are certain rules. But in our case, it's very easy because there are no such items. And so for the Davis family, it's actually quite easy to calculate the deduction. There is also a limitation of the deduction, which is equal to 20% of the taxable income. So let's calculate the limitation first. The taxable income before qualified business income deduction is going to be $60,568, and 20% of that is $12,114. $12,114 is the absolute maximum amount that the Davis family would be allowed to claim as a deduction on their tax return. That is the limitation. They could not go more than that. But let's calculate the actual deduction, because if it is lower, we have to take the lower amount. So the actual deduction is 20% of the qualified business income. What is qualified business income in our case? You would probably think it's $50,000 that we reported on Schedule C and from which we calculated the self-employment tax, right? Well, not really, because for the purposes of QBI, you do have to account the deductible portion of self-employment tax. So in our case, we take $50,000 and we subtract this adjustment that we calculated to be $3,532, which gives us $46,468. That's the net income from the business for the purposes of QBI. And we multiply that by 20%, and that gives us $9,294. Because $9,000, last time I checked, is less than $12,000, we're going to take the lower amount as the deduction. So to sum up, we do have this QBI deduction of $9,294 in addition to $25,900 standard deduction and the adjustment of income in the amount of $3,532, which is the deductible part of self-employment tax. And so the taxable income for the Davis family for 2022 is going to be $51,274. And the income tax calculated from this taxable income is $5,742. However, do not forget about the self-employment tax, which we calculated earlier, which is the responsibility of Jack to pay with his income tax return. And that we calculated to be $7,064. So we have to add that self-employment tax liability to the income tax liability, deriving the total tax liability for 2022 of $12,806. So to summarize quickly, we've taken $38,726 worth of deductions. However, it didn't help very much because the tax liability of $12,000 is pretty high, which means that if you have self-employed earnings, you do have to be very careful about paying estimated taxes every single quarter to make sure that you are not being penalized and there is no additional penalty incurred when you file your taxes, and also that you don't have much of a liquidity problem when it comes to paying such a huge tax bill, which is one of the reasons to hire a CPA. There are a bunch of different credit credits, and there are certain requirements for every single credit. Obviously, I'm not gonna walk over all of them, just as I did not walk over all of the available deductions. So let's just briefly look at an example to see how much more effective credits can actually be than the deductions. Let's assume that Jack and Jane actually never wrote this book and don't have any proceeds from self-employment income. Let's just assume that they're W-2 employees, and let's also assume that they have a dependent daughter, Lily Davis, and she's 11 years old. So let's also assume that Jack and Jane have made salaries in total of $90,000. We want to keep our total income of $90,000 for 2022 just to make the experiment a little bit cleaner. As I have already stated, the deduction, the standard deduction is still available to them of $25,900 that they can claim on their tax return to reduce their taxable income. So the child and dependent care tax credit is available to you if you took care of your young children under the age of 13, or if you took care of any other dependent. Doesn't necessarily need to be your kid. The expenses and programs that would normally qualify for this credit is if you sent your kid to an after school or preschool or kindergarten, or any expenses that were necessary for you to take care of the dependent, or even if you hired a housekeeper or a cook. However, keep in mind that if you hire a housekeeper, you may be responsible for certain filings and withholding of certain taxes, payroll taxes specifically. So the expenses that are not eligible for this credit would spin around food, clothing, education, and entertainment. If you sent your kid to an overnight camp, for example, that's not applicable for this credit. Or if you paid for transportation that the dependent care did not cover, that is also not deductible. So let's assume that Jack and Jane paid $4,000 for an after-school program for Lily Davis, who is 11 years old, and they paid $4,000. However, the maximum credit per one qualifying person is $3,000. However, also there is a limitation, of course, based on income. So if you file married jointly and you make more than $43,000, then the credit is reduced to just 20% of what you would normally get. So in our case, the normal credit maximum amount is $3,000, and because the expenses are more than $3,000, let's take the maximum, we multiply that by 20%, and we get $600 of the credit for child and dependent care. So because Lily is 11 years old, she is a US citizen, she lived with her parents the entire year, the parents supported her fully, she doesn't have any income of her own, the family would be eligible to claim the $2,000 child tax credit, which is available to pretty much everyone. So the total amount of credits that the Davis family would claim on their tax returns is $2,600. So let's look at their tax return very quickly to summarize. Their W-2 income is $90,000, which is their total income as well. We deduct the standard deduction of $25,900, and then the taxable income is $64,100. The income tax on this amount is $7,284. But because we also claimed tax credits, we have the child tax credit of $2,000. By the way, if you claim that credit, you have to attach Schedule 8812. And then we also claim the credit for child and dependent care expenses in the amount of $600. And if you claim that credit, you have to file Form 2441. So the $2,600 is an offset to the $7,284, which gives you the net tax liability of $4,684. Taxable income in our first case is so much lower, it's $12,000 lower, yet the tax liability in the second case scenario is so much lower. It's $8,000 lower, and that's because the second case scenario, the family was able to utilize the credits, which reduce your tax liability dollar for dollar. The deductions are not capable of doing that. The second case scenario, we were able to utilize $2,600 worth of credits, whereas in the first case scenario, we were able to utilize almost $38,000 of deductions, and we still didn't get we did get the lower taxable income, which is obvious, but the tax liability was not very low, and that's mainly because of the self-employment tax. I hope you found this video insightful, useful, interesting, or at least entertaining. If you have questions about your own personal income tax returns or your business, feel free to connect with me on LinkedIn or my website. I'm a New York licensed CPA, and I can prepare your tax returns and consult you on various US income tax matters. I hope to hear from you and hope to see you in the next video. Have a great day in the meantime, and bye!